Welcome back to Dog Tickers. It is Tuesday, January 27th, 2026. If you are listening to this on your commute, you might want to grip the steering wheel a little tighter, or maybe just double check your portfolio app.
Yeah.
Because we are looking at a really interesting and frankly, a slightly messy setup this morning. We are turning our attention to the Washington, D.C. metro area to break down MainStreet Bank shares. That is ticker symbol MNSB on the NASDAQ.
It is definitely a morning for strong coffee and, maybe a snow shovel if you are actually in D.C.
Right.
They've got quite a bit of snow on the ground, which actually forced the management team to pre-record their earnings call this morning. But looking at the tape, I think the weather is the least of the drama here.
I think you're right.
We are looking at a classic standoff between the headline numbers, which, let's be honest, they look ugly, and the actual mechanics of the business, which look surprisingly robust.
That's the tension we need to resolve today. The press release dropped at 8:00 a.m. Eastern, and if you just glanced at the bold print, you might have winced. The market certainly did.
Oh, absolutely.
MainStreet closed the day down 3.25% at $20.51. Volume was light, about 62,000 shares, but the sentiment was pretty clearly negative. So the mission for this deep dive is simple. Is the market right to punish this stock, or is there something in the engine room that the algorithms missed?
Well, to answer that, you have to look past the first page of the press release. Because if you stop there, the sell-off makes perfect sense. But if you dig into the spread, the deposits, the credit quality, you see a completely different picture emerging.
Let's start with the bear case, though.
Yeah.
I want to play devil's advocate here because I'm looking at these numbers and they don't look great. Why did investors hit the sell button this morning?
They hit the button because MainStreet missed the target. Plain and simple. Wall Street had a consensus range for earnings per share EPS of roughly 49 to 55 cents for the fourth quarter.
Right.
MainStreet posted 46 cents. They missed the bottom of the range. In this market environment where everyone is on edge, if you miss the floor, you get punished.
And the top line wasn't much better, was it?
No, it wasn't. Revenue came in at $18.4 million. The street was looking for something closer to $19.6 million. So on paper, they brought in less cash and kept less profit than the models predicted. If I'm a casual observer or just an algorithm scanning headlines, I see a bank that is shrinking, not growing. That usually explains a sell-off right there.
Okay, so that's the sell trigger. A miss is a miss. But you mentioned looking past the first page. If we zoom out just one level and look at year-over-year performance, does that shrinking narrative actually hold up?
It falls apart completely, and this is where the nuance comes in. I mean, despite missing the quarterly consensus, revenue is actually up 7.1% compared to this time last year.
Okay, 7.1%.
And net interest income, which is the absolute lifeblood of a traditional bank, is up 11% for the full year.
So they are making more money from the actual business of banking than they were a year ago.
Correct. Full year net income was $15.6 million, or $1.76 per share. This isn't a bank in distress, it's a bank in transition.
Right.
The sentiment we're seeing in the market is very show me the money right now.
Yeah.
Investors looked at the revenue shortfall and punished the stock, completely ignoring the narrative about the trajectory.
Well, let's talk about that trajectory, because management used a very specific phrase on the call. They kept talking about a return to core banking.
They did.
Now, to me, that sounds a lot like corporate speak for we ran out of growth ideas. Is that cynical?
A little bit, but understandable. However, in this context, return to core banking means something specific. It means they are done chasing growth just for the sake of getting bigger. They are optimizing. And if they are truly returning to core banking, the single most important metric to prove that is the net interest margin, or NIM. Okay,
let's unpack the NIM. This is the difference between what they pay out in interest on deposits and what they collect on loans. Where did it land?
It came in at 3.46% for the year. That is up 33 basis points year over year.
For the listener who doesn't live inside a banking spreadsheet, 33 basis points is 1/3%. That doesn't sound like a massive number to get excited about.
In the banking world, expanding your margin by 1/3% in a single year is heavy lifting. It is huge.
Really?
Yeah. You have to remember, banks operate on razor-thin margins multiplied by massive leverage, expanding that spread while everyone else is fighting just to keep their margins flat. That is the difference between a mediocre year and a stellar one internally.
How do they pull that off? Usually when rates are moving around like they have been, Margins get squeezed because customers demand higher interest on their savings.
It's all about the liability side of the balance sheet, the deposits. CFO Alex Berry was very clear about this. They have been obsessed with deposit mix optimization. And here's the stat that honestly made me do a double take. Year over year, they drove their cost of deposits down by 71 basis points.
Whoa, wait a second. Down.
Yeah.
In a world where every customer I know is moving money to 5% high-yield savings accounts, MainStreet lowered their cost of funding by nearly 0.75%. That seems almost impossible. How do you lower rates without customers fleeing?
You don't compete on rate. If you're a generic bank, you have to offer high rates to keep people. MainStreet is pivoting to niche targeting and their branch-light strategy. They are finding pockets of money that care more about service, access, and relationship than squeezing out the last basis point of yield.
You mentioned branch light, which usually means we don't have many buildings, but I noticed they are actually opening a new one, right?
They are, but it's strategic. They are opening a branch in Middleburg, Virginia in February. Now, for those who don't know the D.C. metro geography, Middleburg isn't just a suburb. It's distinct.
Oh, I know Middleburg. It's horse country. It's hunt country. Old money, stone walls, very extensive estates. It's not exactly a strip mall location.
Exactly. It is a high-wealth enclave. And MainStreet hired Devin Porter to lead that market. His parents were banking legends in that specific area, so he has the Rolodex. He knows where the bodies are buried, so to speak.
And has it worked? I mean, the branch isn't even open yet.
That's the crazy part. CEO Jeff Dick mentioned that Devin Porter has already accumulated over $100 million in low-cost deposits before the doors have even opened.
$100 million before opening day.
$100 million. That is virtually unheard of. And that money isn't hot money chasing a CD rate. That is sticky relationship money. That is how you drive your cost of funds down 71 basis points. You go to where the cheap cash lives and you build a relationship with it.
That is a fascinating insight. It's sniper-style banking versus shotgun style. Because so they are bringing in cheap money. That fixes the cost of fund side. But what about the other side of the equation? What are they doing with that money?
Right.
Because if you have cheap cash, but you lend it out to people who don't pay you back, you still go broke.
Right. The asset side. Management, specifically Jeff Dick and Alex Berry, guided for 3 to 4% loan growth in the first half of 2026.
Which feels modest. 3% growth isn't exactly setting the world on fire.
It's prudent. Remember, return to core banking. They aren't trying to blow the doors off. They are trying to lend safely. And if you look at the credit quality, it's pristine. Tom Floyd, the chief lending officer, basically took a victory lap on the call regarding their charge-offs.
Charge-offs being the loans that went bad and they had to write off as a loss.
Right. And for MainStreet, annual net charge-offs were virtually zero.
Zero in this economy.
Virtually. Think about the headlines we see every day. Commercial real estate crashing, office vacancies soaring. For a regional bank to sit there and say we have zero charge-offs is a massive flex. It implies their underwriting standards are incredibly strict.
But let's push on that commercial real estate point. CRE is the boogeyman in the room for every regional bank right now. Are they just getting lucky, or are they structured differently?
They are actively shifting. They are pulling back on standard CRE to manage risk. Instead, they are leaning heavily into owner-occupied CRE. It now makes up 24% of their portfolio.
Can you explain the difference for the listener? Why is owner-occupied safer than standard CRE? Why does that make me sleep better at night?
Think of it this way. Standard CRE is like me buying an office building and hoping to rent it out to 10 different companies. If those companies leave, I can't pay the mortgage. The bank is betting on my ability to be a landlord.
Okay, that makes sense. It's speculative.
Right. Owner-occupied is where the business that owns the building also operates inside it. Think of a dentist owning the building for her practice, or a manufacturing company owning its plant. The borrower's operating business pays the loan, not third-party rent checks. It implies a full relationship with the borrower.
I see.
They will fight tooth and nail to keep that building because it's their livelihood, not just an investment property.
It aligns the incentives much more tightly. Now, there's another niche here that I think is even more interesting than the real estate. The government contracting, or GovCon portfolio. Living in D.C., GovCon is everywhere. How does MainStreet play this?
Well, most people think of GovCon banking as lending money to contractors so they can make payroll while waiting for the government to pay them.
Sure.
And MainStreet does that. They have about 12.3 million outstanding on lines of credit.
That sounds incredibly small. That's a rounding error for most banks.
It is small. But here's the twist. For MainStreet, GovCon isn't a lending play, it's a deposit play.
How so?
Tom Floyd broke down the math. The average GovCon borrower has a deposit relationship of $93.6 million.
Wait, hold on. They lend in $12 million, but the clients keep $93 million in the bank.
That's the average relationship size across the portfolio, yes. The ratio of deposits to credit is massive. It's roughly 7-to-1 in terms of funding power.
Why would a company leave that much cash sitting there?
Because government payments are lumpy. You get a massive check for a defense contract, and it sits there until you have to pay subcontractors or buy materials over the next 6 months. MainStreet captures that float. They lend a little bit of working capital, and in exchange, they get a flood of low-cost deposits to fund their other loans. It's another secret weapon for that margin expansion we talked about earlier.
It connects back to the margin story. It's all connected. The Middleburg branch, the GovCon niche, it's all designed to bring in cheap cash so they can lend it out at a healthy spread.
Exactly. And just to wrap up the risk side, because investors are always paranoid about small banks blowing up, they ran a worst-case stress test, the doomsday scenario.
How bad was it?
They modeled a hypothetical $62.9 million loss. Even if that happened, their CET1 ratio, which is the key capital safety metric regulators look at, would sit at 11.8%.
Wow.
That is well above the regulatory definition of well-capitalized.
So the house is sturdy.
The house is built of brick.
Okay, so let's summarize the internal view. We have expanding margins, pristine credit, a fortress balance sheet, and a cost of funds that is dropping. But the stock is trading at $20.51 down on the day. Management clearly thinks the price is wrong, don't they?
They absolutely do. And usually when a CEO thinks the stock is cheap, they just say, we think the stock is cheap on the call. MainStreet went a step further. They're putting their money where their mouth is. They are buying back stock.
How aggressive were they?
In Q4 alone, they repurchased 209,000 shares. And the CFO, Alex Berry, made a point to say these buybacks were 28% accretive to book value.
Let's translate accretive to book value for the listener. That sounds like heavy banker jargon. What does that actually mean for my wallet?
It means they bought the shares for less than they're actually worth on paper. Specifically, as of year-end, MainStreet was trading at roughly 80% of its tangible book value.
Can you define tangible book value simply?
Sure. Imagine you liquidated the bank today. You sold all the buildings, collected all the loans, paid off all the debts, and put the cash in a pile. That pile is tangible book value.
Okay.
Right now, the stock market is selling you a claim on that pile for 80 cents on the dollar.
So they're buying a dollar bill for 80 cents.
Basically, yes. So every time they buy back a share at that discount, the remaining shareholders instantly own a bigger slice of the pie, and the mathematical value of that slice goes up. It's an immediate win.
It's essentially the management team saying, if the market won't value us correctly, we will just buy ourselves out at a discount.
That is the signal. It's a very strong vote of confidence.
So we have the internal picture. Let's look at the external, the investor context.
Yeah.
Why is the market ignoring this? Why is MainStreet down on the month when the regional banking ETF, the KRE, is up? Why is there such a disconnect?
It's the liquidity trap. We have to remember MainStreet is a small cap, bordering on microcap. We saw 62,000 shares trade today. That is tiny volume.
Right? Big institutional investors, the BlackRocks and Fidelities of the world, they can't really buy this stock easily. They would move the price too much if they tried to enter.
Exactly. They are too big for the door. So you have inefficient price discovery. The market is grading these banks on two things right now. NIM durability. Can you keep your margins up? And deposit beta. How fast do you have to raise rates to keep customers?
And MainStreet is acing both of those.
They are. But because they're small and because they missed the headline revenue number, the algos and the casual investors just sold the news. The disconnect between the NIM improvement and the stock price drop is largely because people aren't looking under the hood. They see a miss and they move on.
What about the macro wins? We are looking at 2026. Rates are expected to be stable or maybe falling. How is MainStreet positioned for that?
They are positioned well. 67% of their loans reset beyond 6 months. The rest have floors. So if rates fall, their cost of funds, those deposits, will likely fall faster than their loan yields. That means the margin could expand even more.
So the wind is at their back, operationally speaking.
It seems so. The forward guidance is to watch the expense run rate in the first half of 2026. They expect it to stay consistent with Q4. If they can keep expenses flat, hit that 3-4% loan growth, and keep credit quality clean, the math says the stock has to re-rate eventually.
Eventually being the operative word. The market can remain irrational longer than you can remain solvent, as they say.
Or, in this case, the market can remain uninterested. But that lack of interest is where the opportunity usually hides.
Which brings us to the part of the show where we stop being analysts and start being a little more creative.
The dangerous part.
The dangerous part. It is time for our This Is Not Financial Advice segment. Remember, we are just two voices in your headphones. Do your own research. But if you were a hedge fund analyst pitching a wild idea to your investment committee based on this earnings call, what is the pitch?
Okay, I've been workshopping this. I call this trade the fox hunt arbitrage.
I love it.
Or maybe the Middleburg squeeze.
I love it already. Lay it out.
Here is the thesis. You have a stock, MNSB, that is illiquid and low float. It is trading at 80% of its tangible book value. That is a 20% discount on the actual equity of the business.
$1 for 80 cents. Check.
Right. Now, on top of that, you have a management team that is aggressively buying back shares. They are removing supply from the market every single day. They are essentially acting as a liquidity vampire, sucking up the float.
So the supply of shares is shrinking rapidly.
Rapidly, and at the same time, they are opening this branch in Middleburg Hunt Country. We know they already have $100 million in deposits lined up. That is cheap fuel. This is a specific bet on their ability to gather assets in wealthy Virginia suburbs.
So what's the trade? Just buy the stock.
No, that's too simple. That exposes you to sector risk. If all regional banks tank because of some macro news, MainStreet goes down too. You don't want that beta.
True. So how do we hedge?
You go long MainStreet bank shares, MNSB. You are buying the discount, the buybacks, and the Middleburg deposit story. But then you short a generic high deposit beta regional banking ETF.
Like the KRE.
Exactly. You short the sector. You are hedging out the general risk of banking. You are isolating the alpha. You are betting that MainStreet's specific story, the 71 basis point drop in funding costs, the buybacks, the wealthy horse country deposits, will outperform the generic regional bank that is struggling with high rates and bad office loans.
It's a pair trade. You are betting on the boutique over the supermarket.
Precisely. You aren't playing for the earnings pop, but we already missed that and it went the wrong way. You are playing for the privatization floor. You are betting that management will keep buying the stock until the market realizes it's worth book value. It's an arbitrage on MainStreet's superior plumbing versus the sector's rusty pipes.
The fox hunt arbitrage. Long the hunters, short the herd. I like it. But again, listeners, highly illiquid stock. The spread between the bid and ask price can be wide. Slippage is real. Do not try this at home without a helmet.
Definitely requires a helmet and patience. This is a grinded out trade, not a day trade. You have to let the buybacks do the work over months.
All right, let's bring it home. Recap time.
Simple story. MainStreet bank shares reported Q4 earnings. They missed on the headline numbers, revenue, and EPS, and the stock dropped 3%.
Right.
But the internals tell a completely different story. Net interest margin is expanding significantly. Cost of funds is dropping like a rock thanks to a smart deposit strategy. Credit quality is nearly perfect with zero charge-offs.
And they are buying back their own stock at a discount to book value.
The market looked at the headline and sold. The balance sheet suggests the turnaround to core banking is actually working under the hood. The disconnect is wide, and for the patient investor, that gap is interesting.
And if you want to see if this narrative holds up, the management team will be out in the wild soon.
Yes, keep an eye on February 4th and 5th. They will be at the Janney Conference in Scottsdale. That's the next chance to hear if the Middleburg branch opens smoothly and if that loan growth is materializing.
We will be watching. That does it for this deep dive into MainStreet bank shares. A little snow in D.C. couldn't stop the earnings, and a headline miss can't hide the margin expansion if you know where to look.
Thanks for listening to Talk Tickers. We'll see you on the next print.
See you then.